What if the market starts preparing for expansion long before price begins moving? What if hidden changes in planetary motion begin creating timing pressure beneath the market before volatility ever becomes visible? In this session, we will study how changes in planetary velocity can project future intraday timing windows before major market expansion begins. You will be learning this upcoming Gann Astro methods in depth. Gann Astro Planetary Velocity Compression Method. Gann Astro Eclipse Resonance Trading. Gann Astro Harmonic Resonance Index. Before we begin, please note the following financial disclaimer. This content is provided for educational purposes only and should not be considered financial or investment advice. Trading futures and options involves substantial risk and may not be suitable for all investors. Always conduct your own research before making any financial decisions. Now think about this. Two identical price targets. Two completely different journeys. One market reaches its destination within minutes. The other takes several hours. So where does this difference in timing actually come from? Most traders focus on where the market is going. But very few ever ask why the market sometimes moves faster and other times slows down before reaching the same destination. This reveals something deeper. Markets are not only defined by price and direction. They are also defined by changing velocity. Every trend, consolidation, and reversal unfolds at its own unique rate of motion. Now, another important question begins appearing. If the market is constantly changing its speed, could the planetary motions governing our timing analysis also be changing their speed in a similar way? Everything moving through space possesses velocity. Planets are no exception. Their motion is continuously accelerating, slowing, or changing as they travel through their orbital paths. These subtle variations create an evolving geometric rhythm across time. Now think carefully about this. If planetary velocity is constantly changing, then the market may also be responding to these changing rates of motion instead of only fixed planetary positions. This introduces a completely different perspective. Instead of studying planetary location alone, we begin studying planetary motion itself. The market is no longer viewed as reacting only to where a planet is, but also to how its movement evolves through time. Most traders observe candles after momentum becomes obvious. But by studying changes in planetary velocity, we begin searching for periods where timing pressure may already be building beneath the surface. This shifts the focus from reacting to volatility toward anticipating when it may emerge. Imagine a rotating machine whose gears gradually slow down before suddenly accelerating again. The changing speed of those gears tells us that internal conditions are evolving even before the final movement occurs. Planetary velocity behaves in a remarkably similar way. This is the foundation behind the planetary velocity compression method. Rather than relying solely on planetary positions or traditional aspects, we investigate how changes in rotational speed may reveal future timing windows where market instability begins developing. Now let's see how this methodology is applied to a real market. For this example, we will use the Nasdaq 100 E-mini futures. The first step is identifying an important swing point that will serve as our rotational anchor. On the chart, we can see a significant swing low forming on the 4th of June, 2026 at 9:30 in the morning, New York time. Every timing projection inside this methodology begins from a precisely defined market event. Once this anchor has been established, the next step is collecting the planetary information that existed at that exact moment. This astronomical data will become the mathematical foundation for our entire timing projection. To obtain the planetary data, I will use SolarFire, one of the most widely used professional astrology software packages. By entering the exact date and time of our market anchor, SolarFire provides the planetary longitude and the instantaneous angular velocity at that precise moment. For this example, I have selected the Moon. The reason is quite simple. Among the major planetary bodies, the Moon has one of the fastest apparent motions through the zodiac. Because of this higher angular velocity, it naturally produces shorter timing intervals, making it particularly suitable for intraday and short-term market analysis. At 9:30 in the morning on the 4th of June, 2026, SolarFire shows the Moon positioned at 300.37 degrees of tropical geocentric longitude. At the same moment, its angular velocity is measured at 12.01 degrees per day. These two values are all we need to begin calculating the future timing projection. Now that we have collected the Moon's longitude and its angular velocity, the next question becomes, how do we convert this rotational motion into time? Inside this methodology, we do that by selecting a harmonic interval. For this example, we will use a 90-degree harmonic. A full rotational cycle consists of 360 degrees, so 90 degrees represents 1/4 of that complete cycle. Throughout rotational geometry, quarter-cycle movements frequently appear as important harmonic relationships, making them ideal candidates for projecting future timing windows. To convert this angular movement into time, we use a simple mathematical relationship. Time equals angular distance divided by angular velocity. Here, the angular distance is 90 degrees, while the moon's angular velocity is 12.01 degrees per day. By inserting these values into the equation, we obtain 90 divided by 12.01. This calculation produces a projected interval of approximately 7.49 days. At first glance, the answer may appear complete. However, the decimal portion still represents time. So before we can project a future market window, we must convert that decimal into hours and minutes. The calculation gives us a total of 7.49 days. The whole number is straightforward. It represents 7 complete days. The remaining decimal, 0.49, must now be converted into hours. To do that, we simply multiply the decimal portion by 24 hours. 0.49 multiplied by 24 gives us 11.76 hours. Notice that we still have a decimal remaining. This tells us the projection is even more precise, so one final conversion is required before we obtain the complete timing interval. The remaining decimal portion is 0.76 hours. To convert hours into minutes, we multiply by 60. 0.76 multiplied by 60 produces 45.6 minutes, which we can reasonably round to 46 minutes. Our mathematical projection is now complete. Starting from the original swing, the moon requires approximately 7 days, 11 hours, and 46 minutes to complete this 90-degree harmonic movement. The next step is simply applying this interval to our original market anchor and projecting the future timing window. Now, let's apply the calculated interval to our original swing. The market anchor occurred on the 4th of June, 2026, at 9:30 in the morning, New York time. Adding 7 days, 11 hours, and 46 minutes brings us to approximately the 11th of June, 2026, at 9:16 in the evening. Notice something interesting. Up to this point, we have not analyzed market structure. We have not measured support or resistance. We have not used moving averages, oscillators, or Fibonacci retracements. Everything has been calculated using only the moon's angular velocity and a simple rotational harmonic. Now comes the most important question. Will the market actually respond when this projected timing window arrives? The calculation is complete, and the projected timing window has now been placed directly onto the chart. The first vertical line marks our original swing low on the 4th of June, while the second vertical line represents the mathematically projected timing window occurring on the 11th of June. As price approaches the projected timing window, begin observing the behavior of the candles. Is momentum accelerating, slowing down, or beginning to change? This is where mathematics transitions into market observation. Now observe what begins happening as price reaches the projected timing window. Selling pressure gradually weakens. Buyers begin stepping into the market, and bullish momentum starts building almost immediately after the projected window is reached. Notice that the calculation never attempted to predict the exact price level where the reversal would occur. Instead, it projected when the market was more likely to transition from one phase into another. Once the timing window arrived, price itself provided the confirmation. Buyers entered the market, bullish pressure increased, and the Nasdaq 100 E-mini futures continued expanding higher over the following sessions. Now let's look at another real market example. This time, we'll apply exactly the same methodology to Bitcoin and see whether the harmonic timing projection produces another high-probability timing window. Here, I've selected a significant swing low that formed on the 23rd of May, 2026 at 3:30 in the morning, New York time. Now that we have our reference point, we need the moon's astronomical position at that exact time. For this, I am using SolarFire to obtain both the moon's longitude and its daily velocity. At the selected pivot, the moon's longitude is 150.86 degrees, and its average daily velocity is 13.32 degrees per day. These two values are all we need for the timing calculation. The longitude tells us where the moon is positioned in the zodiac, while the velocity tells us how quickly it is moving each day. Once we have these values, we can begin projecting future harmonic timing intervals. Now comes the mathematical part of the process. For this example, We're using the 45-degree harmonic interval. The relationship is very straightforward. Time equals the selected angular distance divided by the moon's angular velocity. So we divide 45 degrees by 13.32 degrees per day. The result is approximately 3.378 days. This means that after roughly 3.378 days from our selected pivot, we should expect an important timing window to appear. The calculation gives us 3.378 days, but charts work with calendar dates and clock time. So now we convert the decimal portion into hours and minutes. The whole number is 3 days. The remaining decimal is 0.378. Multiply 0.378 by 24 hours. This gives approximately 9.072 hours. The whole number is 9 hours. Now, take the remaining decimal, 0.072, and multiply it by 60 minutes. This gives approximately 4.32 minutes. Rounding to the nearest whole number gives us 4 minutes. So our final projected interval becomes 3 days, 9 hours, and 4 minutes. Now we have converted the mathematical result into a practical trading interval. Instead of working with decimal days, we now have a precise timing window consisting of 3 days, 9 hours, and 4 minutes. This is the interval that we will add directly to the original swing low. The important point here is that we are not estimating or visually guessing the timing. Every value comes directly from the planetary velocity calculation. Now let's convert that interval into an exact calendar date. We begin from the original pivot on the 23rd of May, 2026 at 3:30 in the morning. Adding 3 full days brings us to the 26th of May at 3:30 in the morning. Adding another 9 hours moves the projection to 12:30 in the afternoon. Finally, adding 4 minutes gives us a projected timing window of 12:34 in the afternoon on the 26th of May, 2026. This is the exact moment we will monitor on the chart. Now that we have the projected date and time, we can place it directly onto the chart. The red vertical line marks our projected timing window. Notice that no future price action has been used in this calculation. Everything was determined before looking ahead. The only information required was the original pivot, the moon's velocity, the selected harmonic interval, and the simple timing calculation. Now comes the most important part. We wait and observe how price behaves once it reaches this projected window. As price reaches the projected timing window, we immediately begin to see buying pressure entering the market. Time identifies when a change in vibration is likely to occur. Price then confirms that timing through its own reaction. As buying pressure continues to build, the market confirms that the projected timing window has successfully identified an important turning point. This provides traders with an objective timing advantage. Instead of reacting emotionally after a move has already started, we already know when to pay close attention to the market. The timing projection becomes the trigger, while price action provides the confirmation. When both time and price align together, the probability of a meaningful move increases significantly. Now that we've explored harmonic timing using planetary velocity, it's important to understand that no single astronomical technique can explain every market movement. Planetary motion is continuous. It provides an excellent framework for projecting harmonic timing intervals, but markets don't always respond to continuous motion alone. Sometimes, the strongest reactions occur around major celestial events where multiple astronomical bodies align at the same moment. That naturally leads us to the next evolution of our research. Instead of measuring the daily movement of a planet, we'll now study one of the most powerful astronomical alignment events in nature, the eclipse. This method is called eclipse resonance cycles. Rather than using continuous planetary motion as our timing anchor, we'll use rare astronomical events to project future market timing windows. In many situations, these fixed celestial anchors can reveal timing opportunities that planetary velocity alone may not capture. Let's see how it works. Every astronomical timing method observes the sky from a different perspective. The previous technique, measure motion. This one measures alignment. Planetary velocity allows us to track the continuous rhythm of celestial movement. But every so often, nature produces something far more significant, a moment when the sun, moon, and earth align with extraordinary precision. These events are called eclipses. Rather than asking how fast a planet is moving, we'll now ask a different question. Can these rare astronomical alignments become powerful reference points for future market timing? That's exactly what we're about to explore. Let's begin by selecting the astronomical event that will act as the foundation of our eclipse resonance cycle calculation. From the Solar Fire Eclipse database, I have selected the solar total eclipse that occurred on the 4th of December, 2021. Every eclipse occurs at a unique position along the ecliptic. This position is known as the eclipse longitude, and for this particular eclipse, the recorded longitude is 12 degrees, 22 minutes, and 2 seconds. We're going to analyze U.S. oil on the daily time frame. The asset itself is important because every market responds differently to astronomical timing, so we always perform our calculations using the asset we intend to trade. Now let's move over to the U.S. oil price chart. The very first thing we do is mark the exact date of the selected solar total eclipse, which occurred on the 4th of December, 2021. At this stage, we are not attempting to predict whether price will move higher or lower. Instead, we are establishing an astronomical reference point that will serve as the origin for every future resonance calculation. Think of this date as the first vibration from which the entire timing cycle begins. The eclipse longitude is currently expressed in degrees, minutes, and seconds. Although this format is useful astronomically, mathematical calculations become much easier when everything is represented as decimal degrees. Therefore, we convert 12 degrees, 22 minutes, and 2 seconds into decimal form. After performing the conversion, the eclipse longitude becomes approximately 12.367 degrees. This decimal value will now be used throughout the remainder of our resonance calculations. The next step is selecting a harmonic angle. For this example, we will use the 45-degree harmonic, which represents one of the primary harmonic divisions used in cyclical market analysis. We subtract the eclipse longitude from the selected harmonic. 45 degrees minus 12.367 degrees produces a resonance angle of approximately 32.633 degrees. This remaining angular distance represents the amount of vibration required to complete the selected harmonic relationship. Now that the resonance angle has been calculated, we amplify it using our resonance constant. For this model, the constant is 12, representing the 12-fold harmonic expansion used throughout this methodology. Multiplying 32.633 degrees by 12 produces a resonance value of approximately 391.596. This value represents the raw resonance cycle before it is converted into market time. The resonance value that we calculated represents an angular quantity rather than market time. To transform this value into something that can be applied directly to price charts, we convert it into swing trading days. For this methodology, we divide the resonance value by 6. This conversion factor is used to translate the astronomical resonance into a practical market timing cycle. Dividing 391.596 by 6 gives approximately 65.266 trading days. For practical chart analysis, we round this value to approximately 67 calendar days, creating our primary eclipse resonance cycle. Rather than stopping with a single timing projection, we extend the cycle forward repeatedly. Markets often respond to harmonic repetition, where the same cycle continues to resonate over longer periods of time. Starting with a primary resonance cycle of approximately 67 days, we project additional windows by simply multiplying the cycle. We now test the first projected resonance. Beginning from the solar total eclipse on the 4th of December, 2021, we count forward 67 days. This projects our first resonance window to approximately the 9th of February, 2022. Notice how the market reacts as price approaches this projected date. The market respected the timing window and continued its existing bullish trend shortly afterward. The second projection is obtained by doubling the original resonance cycle. 2 multiplied by 67 produces approximately 134 days. Counting forward from the original eclipse date projects the next timing window to approximately the 18th of April, 2022. As price reaches this date, we once again observe an important reaction developing within the market. Notice that the timing window coincides with a meaningful change in market behavior. Next, we project the third resonance. Multiplying the original cycle by 3 produces approximately 201 days. Measured from the solar total eclipse, this projects a timing window near the 24th of June, 2022. Once again, the market produces a small correction printing back to backup close candles. Continuing the sequence, we multiply the resonance cycle by 4. This produces approximately 268 days from the original eclipse. The projected timing window falls near the 30th of August, 2022. Notice how the market reaches this projected timing window after an extended bearish decline. As price enters the resonance zone, selling pressure begins to slow and buyers temporarily step into the market. Although this reaction does not immediately create a major trend reversal, it produces a clear short-term recovery and a noticeable change in market momentum to the downside. The fifth resonance is obtained by projecting 335 days from the original solar total eclipse. This places the next timing window around the 5th of November, 2022. Once again, the market reacts remarkably close to the projected resonance date. Price attempts one final upward rally into the timing window, but quickly encounters strong selling pressure. Shortly after the resonance is reached, buyers lose control and the market transitions into another sustained bearish decline. Most traders ask one important question before performing any eclipse calculation. Which eclipse should I actually select? If the starting point is chosen randomly, then every calculation that follows becomes unreliable. That is why eclipse selection is one of the most important parts of this entire methodology. Before we perform any mathematical calculations, we must first establish an objective rule for selecting our astronomical anchor. Rather than choosing eclipses based on hindsight or the best-looking chart, we use a fixed rule that can be applied consistently across every market. This removes subjectivity from the analysis and ensures that every resonance cycle begins from the same logical foundation. A repeatable process is far more valuable than a perfect-looking historical example. The first step is identifying the market swing that we want to study. This could be a major swing high, a major swing low, or the beginning of a significant trending movement. The market swing simply defines the region we intend to analyze. Once that swing has been identified, we can begin searching for the appropriate astronomical reference. The next step is locating the most recent eclipse that occurred before the selected market swing. This becomes our reference eclipse. Notice that we are not selecting an eclipse after the market has already reacted. Instead, we always move backwards in time and identify the nearest eclipse that existed before the swing developed. This creates an objective starting point and removes hindsight bias from the methodology. At this stage, another important decision appears. Which type of eclipse should we use? For this example, I have selected a solar total eclipse. However, the methodology is not limited to solar total eclipses. Depending on the asset being studied, the same process can also be applied to solar partial eclipses, annular solar eclipses, hybrid solar eclipses, lunar total eclipses, lunar partial eclipses, and penumbral lunar eclipses. The eclipse simply becomes the astronomical anchor from which all future resonance cycles are projected. One of the objectives of this backtesting is discovering which eclipse category produces the most consistent market timing for a particular asset. Different markets often respond differently to astronomical cycles. For example, one asset may produce stronger resonance using solar total eclipses, while another market may respond more consistently to lunar total eclipses. This is why eclipse selection becomes part of the research process rather than a fixed assumption. After selecting the eclipse, we extract its astronomical information. This includes the eclipse date, time, longitude, and any additional parameters required by the calculation. These values remain fixed throughout the entire analysis. Every resonance cycle, harmonic projection, and future timing window will now originate from this single astronomical event. Once the eclipse has been selected and its astronomical data has been recorded, the mathematical process begins. From this point forward, every future timing projection is generated using the same resonance calculation. Because every projection originates from a fixed celestial event, the methodology remains consistent, repeatable, and easy to validate across different markets. Harmonic Resonance Index. Now, what if the market is responding to the angle created between two celestial bodies instead? What if that hidden geometric relationship contains valuable timing information that most traders completely overlook? Imagine looking at the zodiac as a complete 360-degree circle. Every planet occupies a different position within that circle, and the distance separating two planets is constantly changing. Sometimes they are very close together, while at other times they are positioned on opposite sides of the zodiac. These changing angular relationships create unique geometric patterns that can be measured mathematically and studied alongside market behavior. To standardize every planetary relationship, we compare the angular separation against the complete 360-degree zodiac. This produces what we call the planetary harmonic ratio. Instead of asking how fast a planet is moving, we ask how efficiently the planetary angle divides the zodiac into harmonic segments. This creates a completely different way of analyzing astronomical timing. Different planetary combinations will produce different harmonic ratios, allowing us to compare market behavior across multiple astronomical configurations. Rather than relying on a single celestial body, we begin studying the geometry created between two moving planets. Once the planetary harmonic ratio has been calculated, it can be transformed into future timing cycles using harmonic projections. Now, let's see how it works on charts. In this example, we begin by selecting an important market swing that occurred on Tuesday, the 22nd of October, 2024. For this particular asset, we are observing the geometric relationship between the Moon and Mercury. Every market behaves differently, so the planetary combination should always be chosen after historical observation and testing. Once the swing has been selected, we record the planetary longitudes on the exact same day. I am using my Gann Astro software to get the degree values and differences between two planets. I provide this software only to serious traders in my teachings. Now, on Tuesday, the 22nd of October, 2024, the Moon was positioned at approximately 315.4598 degrees, while Mercury was positioned at approximately 147.1537 degrees. The difference between these two planetary positions represents the angular separation. This angle becomes the foundation of our harmonic calculation. Next, we convert the planetary angle into what we call the harmonic resonance index, or simply the HRI. We divide the angular separation by a complete circle of 360 degrees. This normalizes the planetary relationship into a harmonic ratio. Once the harmonic ratio has been calculated, we multiply it by 144, which is our harmonic timing constant. The final result gives us a projected cycle of approximately 67 trading days. Beginning from our original swing on Tuesday, the 22nd of October, 2024, we project the first harmonic interval of approximately 67 trading days. This projection brings us to Monday, the 30th of December, 2024. Notice what happens as price reaches this projected timing window. Rather than entering a trade simply because the date has arrived, we wait for confirmation for price action. In this case, the market forms a bullish market structure shift, providing a high probability long opportunity exactly inside the projected resonance window. Adding another cycle of approximately 67 trading days brings us to Friday, the 7th of March, 2025. Once again, the market begins responding inside the projected timing window. Rather than producing a major reversal, price confirms the existing bullish trend and resumes its upward movement. We continue projecting the same harmonic cycle forward. Adding another interval of approximately 67 trading days projects the next resonance window to Wednesday, the 14th of May, 2025. As price enters this new timing window, the market once again produces a strong bullish continuation. Notice that the harmonic rhythm established at the original swing continues to influence market behavior several months later. This repeated response increases our confidence that the original planetary geometry is still interacting with the market cycle. One important point to understand is that the harmonic constant is not fixed. Different financial markets have different natural rhythms, which means a single value will not necessarily work equally well across every asset. For swing trading, I generally use 144 because it consistently aligns with major Gann harmonic cycles and has produced reliable timing windows during historical testing. In my own research, this value has provided the most stable and repeatable market reactions. However, you are free to optimize this constant using historical testing. Some markets respond better to other Gann numbers. For example, 72 often works well for shorter swing cycles. 90 can capture intermediate market rhythms. 108 frequently aligns with harmonic expansion cycles, while 180 is sometimes more effective for longer-term market movements. Every financial market has its own harmonic rhythm. That is why it is important to test this methodology across different asset classes. In this example, we will analyze the Nasdaq 100 futures. Beginning from the swing high on the 22nd of November, 2021, we will calculate the planetary harmonic relationship and project future reversal dates. To perform these calculations, I'm once again using my proprietary Gann Astro software. It allows me to calculate planetary positions and angular relationships with precision, making the entire process far more efficient than performing every calculation manually. This is one of the specialized research tools I use throughout my own analysis and with dedicated students who are learning this methodology in depth in my private teaching. For our reference date of the 22nd of November, 2021, The software shows that Mercury is positioned at approximately 236.712 degrees, while Jupiter is positioned at approximately 324.3659 degrees. The angular separation between the two planets is therefore 87.6538 degrees. To normalize the planetary angle, we calculate the harmonic resonance index. We divide the angular separation by the full 360-degree zodiac. The calculation produces a harmonic resonance index of approximately 0.243483. This value represents the percentage of one complete harmonic cycle occupied by the Mercury and Jupiter relationship. By itself, this number has no timing meaning. Its purpose is to act as a scaling factor for harmonic projections. Now we convert the harmonic resonance index into time. For this example, instead of using 144, we intentionally use the 180 harmonic constant. The calculation is straightforward. We multiply 0.243483 by 180. This produces approximately 43.83 trading days. For practical market analysis, we round this value to approximately 44 trading days. This becomes our projected harmonic interval. Starting from the 22nd of November, 2021, we begin projecting forward using approximately 44 trading day intervals. The first projected date falls near the 4th of January, 2022. Adding another harmonic interval brings us close to the 16th of February, 2022. Repeating the same process projects another important window around the 31st of March, 2022. As price approaches the first projected harmonic window around the 4th of January, 2022, we carefully observe market behavior. Instead of blindly entering a trade because of the date, we wait for price confirmation. At this projected timing window, the market forms a bearish rejection and shifts lower. This provides confirmation that the harmonic projection is aligning with actual market structure. Moving forward to the second projected harmonic window near the 16th of February, 2022, we observe another reaction. Once again, price reaches the projected timing zone and forms another bearish reversal. The market continues moving lower after the harmonic date. Notice that we are not changing the calculation. The same original planetary relationship continues, producing future timing windows. This demonstrates how a single planetary geometry can generate multiple harmonic projections. Finally, we arrive at the third projected harmonic window around the 31st of March, 2022. Once again, the market responds near the projected timing date. A bearish rejection develops, and the decline resumes. This completes another successful harmonic projection generated entirely from the original Mercury and Jupiter relationship. 3 consecutive timing windows produce meaningful market reactions using exactly the same harmonic resonance index and the same harmonic constant. This shows an important principle. One planetary relationship is often capable of producing multiple future timing opportunities. Now, a very common question students ask is why we sometimes multiply by 72, sometimes by 144, and other times by 180 or even 360. The answer is actually quite simple. The harmonic resonance index itself never changes. It simply represents the normalized geometric relationship between two planets. What changes is the harmonic constant that we apply to that relationship. Think of the harmonic constant as selecting the time horizon you want to project. Let's use a simple example. Suppose our harmonic resonance index equals 0.5. If we are trading short-term swings, we multiply by 72. 0.5 multiplied by 72 gives us 36 trading days. If we increase the harmonic constant to 90, the exact same planetary relationship now projects approximately 45 trading days. Using 108 extends the projection to 54 trading days. Using 144 projects approximately 72 trading days. 180 projects around 90 trading days. And a full harmonic cycle of 360 projects approximately 180 trading days. Notice something very important. Nothing about the planetary geometry has changed. Only the scale of the projection has changed. This is exactly like using different zoom levels on the same map. The destination remains identical. Only the distance you're measuring changes. So why don't we always use the largest harmonic constant? Because every market has its own dominant frequency. Intraday markets generally respond to shorter harmonic cycles. Swing trading usually responds best to medium harmonic cycles. Position trading often benefits from longer harmonic cycles. Instead of forcing every market to use a single constant, we allow the market itself to reveal which harmonic scale produces the greatest synchronization. Through years of historical testing, I found that 144 consistently provides one of the cleanest harmonic projections for swing trading. However, that doesn't mean it is universally superior. Some markets naturally synchronize better with 72, 90, 108, or 180. This is why optimization is such an important part of the methodology. We're not changing the mathematics. We are simply selecting the harmonic scale that best matches the natural rhythm of the market. Now you may be wondering why I personally use 144 as my default harmonic constant for swing trading. The answer is not because it is a magical number. It is because it represents one of the most stable harmonic scaling factors found throughout Gann's mathematical work. Let's examine it more closely. 144 is simply 12 multiplied by 12. The number 12 appears repeatedly throughout natural cycles, geometry, astronomy, and time measurement. There are 12 months in a year. A complete circle can be divided into 12 equal 30-degree segments. Many harmonic systems are naturally built around multiples of 12. When we square 12, we obtain 144. This creates a harmonic scaling factor that expands proportionally while preserving the original geometric relationship. But there is another interesting observation. 144 is also exactly twice 72. It is 4 times 36, and it maintains simple proportional relationships with many other harmonic numbers used throughout Gann's work. This makes 144 an extremely balanced scaling constant for projecting future market timing. Remember, the harmonic resonance index itself does not predict time. It only tells us where we are inside a complete harmonic cycle. The harmonic constant converts that normalized fraction into an actual market projection. Mathematically, nothing changes. We simply multiply the harmonic resonance index by the selected harmonic constant. For swing trading, that constant is usually 144. We've already discussed why 144 is used as the harmonic constant for swing trading. However, that raises another important question. Why don't we multiply the planetary angle directly by 144 or any other number? Why do we first divide by 360? Let's understand the mathematics behind that normalization process. The reason comes directly from geometry. A complete circle contains exactly 360 degrees. Every planetary position exists somewhere on that circle. If we want to understand how far apart two planets are in harmonic terms, we must compare their separation to one complete revolution. Think of it like measuring progress around a racetrack. Imagine a runner has completed 90 degrees of the track. Saying 90 degrees alone tells us very little. But if we compare it to the entire 360-degree circle, we immediately know the runner has completed 1/4 of a lap. The exact same principle is applied here. The angular separation between the planets is simply a portion of one complete harmonic cycle. By dividing the angular separation by 360, we normalize the value into a fraction. This removes the units and leaves us with a pure harmonic ratio. In our previous example, the angular separation is 87.6538 degrees. When we divide that by 360, we obtain 0.243483. This value is what I call the harmonic resonance index, or HRI. Notice that the HRI is always between 0 and 1. A value close to 0 means the planets are very close together within a cycle. A value close to 1 means they are approaching completion of an entire harmonic revolution. This normalization step is extremely important because every planetary pair can now be compared on exactly the same scale. Whether the angular separation is 20 degrees, 90 degrees, 180 degrees, or 300 degrees, they are all converted into the same universal harmonic measurement. Once we have this normalized harmonic fraction, the geometry is complete. The only thing remaining is to project that fraction into market time using a harmonic constant.